A lot of people are wondering how the insurance prices will get impacted after the devastating LA fires we had. My guest today is Dave Jones, who's the former insurance commissioner in California. He tells us today what's going to happen to insurance prices going forward and how Californians may be on the hook to pay for some of the LA damages in the fires. I'm Siama Korami. Welcome to California Insider. Dave, it's great to have you on. Welcome.
Very nice to join you and your listeners and viewers.
Dave, one of the things that's happening right now after the fires, people are wondering what's the impact to the insurances. Can you tell us what you see?
I think a little bit of background is important. What's been happening in California is not unique to California. Across the United States, insurers have found it increasingly challenging to make a profit and write insurance. And that's because we're seeing more extreme and severe weather-related events. Hurricanes, tornadoes, droughts, extreme heat, floods, severe convective storms, and wildfires are all occurring more and more across the United States. Really, no place is safe from this. So insurance companies respond to increased losses in two ways. They raise price, and they also reduce the amount of insurance they're writing. And that's what insurance companies are doing across the United States. So in California, for the past couple of years now, insurers have increasingly not renewed home insurance for some homes they think are too risky, and they also paused writing new insurance. So that's a big challenge. And the way that California has responded to that is by changing its regulations of insurance in various ways at the request of the insurers that will allow them to get more rate faster. So the hope is in doing that they'll start writing insurance again. That's certainly what they said when they asked for these changes. We hope that they'll do that notwithstanding the big fires in Los Angeles, but it remains to be seen what impact these large fires are going to have on their appetite to do what they promised to do, which is to keep writing insurance in California.
Now, how much are the damages? People are wondering what's the damage and how is it going to impact everybody else as well?
So first, it's important to distinguish between economic damages and insurance losses because not every property is insured, and a lot of public infrastructure is not insured. The government self-insures. So the estimates now are as much as $150 billion of economic damages or losses from these fires. The insured losses are estimated to be as much as $20 billion. That's a big number. When you think about the wildfires in California in 2017 and 2018, those were about $15 billion each, including the Camp Fire in 2018. So $20 billion is an enormous loss for the insurance industry to have to sustain. Why is that number so high? Well, first, 12,000 structures and counting have burned. So that drives that loss number up for the insurance industry. But also the values of the homes and businesses in Los Angeles that burned are very high. Pacific Palisades has some of the most valuable real estate in the nation. And so that means to the extent the insurance companies are insuring those properties, they're going to have even higher losses because the insurance policies cover larger amounts. I think the other important thing to note, though, is thanks to California's strong insurance regulation, the insurance companies have enough money to pay claims. A part of insurance regulation and strong insurance regulation is making sure that the companies are collecting enough money in premium and then setting enough money aside so that when these catastrophic events occur, there's money to pay claims. So the insurance companies here in California have enough money to pay claims. They have big enough reserves. Also, the other important thing to note is that we have an insurer of last resort called the FAIR Plan, F-A-I-R. That stands for Fair Access to Insurance Requirements. And it has sufficient resources to cover claims as well, although it's a little more complicated because it has 200 million reserves, 2.5 billion in reinsurance, which sounds like a lot, but the amount of exposure that the FAIR Plan has in Pacific Palisades alone is $5.85 billion. It's written $5.85 billion worth of insurance policies. Now, not all the homes that were destroyed in Pacific Palisades and Altadena and other parts are covered by the FAIR Plan, but some are, and enough of them might be covered that the FAIR Plan would exceed the amount of money that it has to pay claims. So what happens then? Well, like every other state, what happens then is the FAIR Plan can then assess member insurance companies. But what's different in California from the general rule is that they can also assess all policyholders in the state of California, thanks to a change in the rule last year. So the bottom line is the FAIR Plan will have enough money to pay claims too. People don't need to worry that it's going to run out of money. But the way that it's going to make sure it has enough money is by assessing all California policyholders eventually if it reaches the point where it has insufficient funds to cover those claims itself.
So do you anticipate, this payment, all policyholders probably have to chip in for this if it gets there?
If it gets there, that's what will happen. And that will be on top of what homeowners and businesses are paying for their own insurance, which is anticipated to rise in price even before these fires. With the regulatory changes that were enacted last year at the request of the insurance companies, those changes were going to allow the insurers to get a lot more rate increases. Then we have these fires, which they're going to use the experience from to ask for even more rate increases. And then you've got this potential assessment from the FAIR Plan on top of that. So it's going to be, sadly, very expensive for Californians to continue to access insurance going forward. Will insurance continue to be available? We hope so. All of these regulatory changes were made at the request of the insurance companies. When they were made last year, the insurers said if these changes were made, they would keep writing insurance. So I believe they should maintain that commitment, but we'll see what they do.
And now for those people that have been impacted, what does the insurance cover?
A couple of things. One is most home insurance policies have what's called adjusted living expense, which is basically coverage for your out-of-pocket costs when your home is destroyed such that you can't live in it any longer. So things like motels, buying food at a restaurant, purchasing clothes, those sorts of things. So those individuals who have lost their homes, who have insurance, ought to contact their insurance company and see if they can get some of that money into their pocket right now to begin covering their costs associated with their being pushed out of their homes. Then the other thing that insurance policies typically cover, up to some limit, is the replacement of the home. And here it gets confusing for people because people oftentimes think about the market price of their home and they insure to that amount as opposed to insuring to the replacement cost of their home, which can be a different amount, in some cases higher. So one thing people should do when they have insurance is double check every year to make sure they have enough insurance to cover what it costs to replace their home. Individuals who lost their homes in this particular set of fires who have insurance will have coverage up to whatever limit is in their insurance policy. Some of these people may be underinsured. In other words, they may not have purchased enough insurance to cover the replacement of their home. If that occurs, sadly, they're going to have to look for other resources to make up that gap. The other thing I think it's important for people to understand is that FEMA, which provides disaster assistance for communities in the wake of these sorts of disasters, they don't help you rebuild your home. At most, maybe you get $20,000, $30,000 from FEMA to help you with emergency assistance. But it's really insurance that you need to have to enable you to recover from a horrific event like this.
Now, for the people that are on FAIR Plan, we have heard that it only covers up to $3 million. Can you tell us, is that true?
Yes, that's right. The FAIR Plan has a coverage limit of $3 million. And so if you're in Pacific Palisades where the average price of a home is $3.5 million, of course, some of that is for the land and location, but some number of those homes will probably exceed the FAIR Plan coverage limit. What folks should have done is if they had to go to the FAIR Plan and the coverage limit of $3 million was less than the overall replacement cost of their home, then they should have bought some insurance on top of that from what's called the surplus lines market, which is a basically unregulated additional insurance market. Think Lloyd's of London, Zurich, companies like that. But sadly, some number of people are probably going to be underinsured, which means sadly they won't get enough money to cover the full cost of replacing their home. And that's a tragic thing, and sometimes it even forces people to decide they may not rebuild. That certainly happened in the Camp Fire up in Paradise in Butte County where some number of people didn't have enough insurance, they couldn't rebuild, and so they decided, well, we're going to have to move, and they would sell their lot to someone else.
Now, for the people that have insurance and they're going to get the insurance funding, and if they have a mortgage, because a lot of people buy these homes with mortgages, do they have to still make the mortgage payment? Or
Yes,
would
they
the
do.
insurance cover that?
Yeah, if your home burns down and you have a mortgage, or your home is damaged and you have a mortgage, you're still responsible for making the mortgage payments. And so that can be a real burden for people. But you can take your insurance proceeds on your home and use that to help pay your mortgage payment while you're also rebuilding your home. Another thing people don't understand too is that every mortgage loan written in the United States of America has a provision in it that requires you to have insurance. And if you don't have home insurance, then the mortgage lender can do what's called force place insurance for you. In other words, they go and get insurance that you didn't get because perhaps you couldn't afford it in some cases. So what that means then is that sometimes people are faced with increasing costs of insurance because their rates are going up. They find themselves, if they're particularly on a fixed income or low income, that they can't make the insurance payment. They drop their insurance. Then the mortgage company forces insurance on them and starts billing them for that. And so then people find themselves with even higher mortgage payments, which can sadly sometimes lead to defaults. And so that's an example where this insurance crisis can flow through the economic system to where insurance prices go up. People have a difficult time keeping insurance. They drop it. Then their mortgage lender gets them insurance, then charges them for that. And then folks find themselves in a circumstance where they can't continue to make their mortgage payment and may default. So we're not seeing a lot of that yet, but that is a potential way in which risk might be transferred through the financial system as a result of what's happening with climate change and more of these extreme and severe weather-related events.
Now, for the people that have the insurance, what are your recommendations to make sure that they get reimbursed correctly?
First, you need to get a hold of your insurance policy, and if it burned, you need to contact your agent or your insurance company and ask them to provide you with a complete policy. Then you need to look at it and understand what it says, and then you need to begin to submit a claim to the insurance company. And so we talked first about these adjusted living expenses that you could do right now, and the law in California is such that you don't have to document with super specificity all of your out-of-pocket expenses. The insurers are supposed to start moving that money to you as soon as possible. But then beyond that, what you'll need to do is let the insurance company know that your home was completely or partially damaged. If it was partially damaged, you need to let them know what was damaged. They may require photographic evidence. You'll submit the claim, and then they will come back and look at what you've claimed and do what's called adjust the claim, which is indicate to you what they think they should have to pay. And then you may end up in a back and forth with the insurance company because oftentimes there are disagreements between you and them as to what should really be covered. Hopefully you've got some information about what the architectural features were, what the appliances were, that sort of thing, because that can be a source of dispute with the insurance company. But even if you don't, you can tell them what you had. And if you find yourself at loggerheads with the insurance company, then you can contact the Department of Insurance. Now, the Department of Insurance does not adjudicate claims. It doesn't sit as a judge over claims, but it does oversee the process of handling claims, and it makes sure that you're being treated fairly and that the timelines are being followed. And if you feel like you are not being responded to, or you're being treated unfairly, or your claim is just not being taken care of, you can contact the California Department of Insurance's consumer hotline and ask that they help you, and they will.
We are honored to be sponsored by Shenyun. I've been attending Shenyun performances every year as they change the choreography and music. Shenyun takes you back in time to the magical world of ancient China with unique blend of brilliant dancing, beautiful costumes, and legends coming to life. Overall, it's a very meaningful performance with a lot more than just entertainment to offer. Make sure to go see it this year. Go to shenyun.com and book your tickets today. I highly recommend it.
People nowadays go to the doctors, the psychiatrists for pills, for antidepressants. This is the antidepressant. The best.
I knew it was going to be good. It's a billion times better than I even thought it would be.
I'd heard people say, you don't want to miss this, and I would fully agree.
I'm going to tell everyone to come see it. You have to.
Definitely going to come back next year.
Totally inspirational. You have to go see this.
It's a once-in-a-lifetime must-see that will change their lives forever.
Dave, you mentioned that there are two types of insurance companies. Some are admitted and non-admitted. What's the difference between the two?
So that's a great question. So admitted insurance companies are the traditional companies that we think of, the ones we see on TV or hear on radio or see on the web. State Farm, Farmers, Geico, AAA, USAA, you name it, right? And these companies are admitted, that is, they're fully licensed to write insurance in this state or any other state in which they're licensed. They're also regulated. Oftentimes their rates are regulated, their reserves are regulated, various aspects of how they conduct themselves are regulated. Then there's another market that's deregulated called the surplus lines market. That's companies like Lloyd's or Zurich or other companies where they're allowed to sell insurance. The price is not regulated. A lot of the aspects of what they do is not regulated, but they're still allowed to sell insurance in the state. So it's an additional market that people can have access to. It's oftentimes more expensive because there's no rate regulation associated with it. It's also a market that you have to access through a particular specialized broker called a surplus lines broker. So this is a lot of information, but what you can do is you can go on the web and browse for surplus lines broker, find one near you, and then those are the individuals that can access the surplus lines market and then help you access surplus lines insurance.
Now, what's the difference? Which one is better? Do the admitted ones, are we clear that they have the funding to pay, or?
Well, so I think there's more regulation around the admitted carriers, and I think there's more security in that their prices are regulated, as well as the conduct of the companies are more regulated, and also their reserves are heavily regulated. The surplus lines companies, they are regulated in their home state, but they're not regulated very much at all in the state in which they're selling insurance, right? So what you're then relying on if you're buying insurance from a surplus lines company is that whatever country or other state that is regulating them is on the job. And, you know, that can be kind of a mixed result sometimes. But I think by and large, the surplus lines companies do a good job. It's just also much more expensive, right? Because there is no rate regulation associated with the surplus lines companies. It's entirely free market. And as a consequence, they charge a lot and a lot more than the admitted carriers.
You anticipate the insurance rates to go up. And do you have a prediction what are the ranges that it might go up?
No, I don't. I do know that based on the regulatory changes that the insurers asked for and got this last year, that they're planning to submit requests for substantial rate increases. Could be 10, 20, 30, 40, 50, 60%. And it might vary. It will vary based on the nature of risk that your particular home faces, because the insurers are also allowed to charge riskier homes more than less risky homes. So it'll be substantial. And then you have, on top of that, the $20 billion and counting losses from the wildfires in Los Angeles. And so the insurers are not allowed to recoup that all at once this next year, but over time they are allowed to raise their rates to recover a substantial amount of that, and they will. So the rates were already going to go up. Now they're going to go up even higher as a result of these wildfires.
Now, when we talk to the insurance industry, they told us that the reason that the rates have to go up significantly is because California has had really low rates for a long time. What are your thoughts on that?
Well, I think most Californians would disagree with the assertion that their rates have been low. And in fact, over the last 5-6 years, rates have been going up quite substantially. Maybe not as much as the insurance companies would like, but they have been, in real objective and absolute terms, been going up a lot. And now they're going to go up even more, right? And so I don't think that the insurance crisis in the state of California is principally driven by an inability to get rate. They have gotten rate increases. It's driven by a dramatic increase in the risk and the losses the companies are suffering. And we're not unique in that regard. There's some 18 states across the United States that are seeing insurance companies raise rates and also decline to write insurance. And in some states, it's even worse. Florida, for example, where it's highly deregulated. The rates are 4 times the national average. The insurance companies have gotten everything that California asked for some time, including the ability to use probabilistic models and rates to include reinsurance costs and rates. There's also 2 taxpayer-funded nonprofit reinsurance facilities to provide cheaper reinsurance for the insurance companies. Whole long list of things, right? But even with all of that, the national carriers, the national insurers, have concluded they can't make money writing in Florida. So Florida is an example where even with the most lax regulation, even with the highest rates, the national insurance companies have decided the risk of loss and the magnitude of loss is just too much for them to be able to write insurance. Now, we're not as bad off as Florida, but we're on that trajectory. And they're also creating new sorts of perils that we really didn't have to deal with before. Severe convective storms. If you had asked someone 10 years ago, what's a severe convective storm? They'd look at you blankly, even knowledgeable people, and say, I have no idea what you're talking about. Well, severe convective storms are now a major contributor to the overall insured natural catastrophe losses in this country and globally. 50% of the insurance losses from natural catastrophes in this country and globally were from severe convective storms this year and last. What are they? What is this? Atmospheric rivers, heavy rain, sometimes hail, heavy sustained rain, sometimes coupled with wind. And it's not the water coming down and flooding that's causing the insurance losses, because the private insurers don't cover flood loss. That's covered only by the National Flood Insurance Program. It's just the damage caused by the heavy rain itself. And it cost last year something on the order of $40 to $50 billion in insured losses. Well, that was never an issue. This is a new phenomenon, and the climate scientists tell us that it's going to continue. We'll continue to have these severe convective storms throughout the United States. It's Ohio, Iowa, Oklahoma, Massachusetts, Vermont, etc. So it's not just the Gulf and Atlantic states like Florida, Louisiana, Georgia, Alabama. It's the interior of the country. It's not just the West, it's the interior of the country. So really there's no get out of climate free card, unfortunately. It's happening all over, and it's having an impact all over, and it's only getting worse, and that's making it harder and harder for insurance companies to keep writing insurance.
Now, Dave, in terms of the FAIR plan, can you explain the FAIR plan for some of our audience that may not know how it works? So if there is an event, they take the money from the insurance companies. Can you explain to us how it works? And
so FAIR plan stands for Fair Access to Insurance Requirements, FAIR. And there's some 35 states that have these FAIR plans. They are not state agencies. They're not funded by taxpayers. They are actually state statutorily created involuntary associations of insurance companies. They're a private insurance. They're not a private association. They're not an insurance company. They're a private association of insurance companies. And the state laws require them to write insurance for the risks that the private insurers won't write. So in California, that's wildfire and home insurance. In Florida, it's wind insurance. In Texas, it's wind insurance. It varies based on the nature of the peril in different states. So now, the way the FAIR plans are structured is that they have to have enough money to cover an average year. Why is that? Well, the FAIR plans are covering the risks that the private insurers won't cover. So they're covering the riskiest homes, the riskiest businesses, and they're not able to spread that over the entire number of policyholders in the state. So it's going to be expensive to cover folks that are the riskiest. So to try to provide some level of relief in terms of the pricing of the FAIR plan policies, state laws don't require them to have the same high level of reserves as an insurance company. Why? Because if they had to have super big reserves like an insurance company, the price would be even higher for FAIR plan insurance and no one could afford it.
Which they're already really high in terms of...
And it's already really high, right, yeah. So instead they're supposed to have enough money to cover a typical year. So what happens if the year is untypical? What happens if you have a catastrophic year like we're having in California? Well, what the state laws provide is that in that circumstance, in just about all the states, the way it would work is the FAIR plan, if it runs out of money, will assess all of the member insurance companies in the state based on their relative market share. So there's some rough justice here, right? So it's the insurance companies that are deciding not to cover particular risks. Those risks end up in the FAIR plan. The states are saying, okay, then they'll be covered by the FAIR plan. But if there's not enough money in the FAIR plan, then we're going to go back to the insurance companies who are the ones that are not covering this risk and driving people to the FAIR plan in the first instance and assess them to cover any shortfall. So that's the state of the law in just about all the states except for Florida, Louisiana, and now California. And the way it works now in those three states, and in California, this law just got changed last year by virtue of an order, is that if the FAIR plan runs out of money, instead of assessing all the member insurance companies for all of the shortfall, it will assess, the insurance companies will assess all of the policyholders in the state, not just the FAIR plan policyholders or everybody. So that's how it is in Florida and Louisiana. California has a slight modification to that. The first $1 billion of shortfall comes from the insurers collectively, and then beyond that, it's the policyholders that have to pay. But this is a big change for California, and we may be approaching a moment associated with the wildfires in Los Angeles where the FAIR plan may not have enough money of its own to cover claims. So then it will have to do this assessment. So that will mean it'll have enough money to pay claims and cover people that have FAIR plan insurance. But it also means that people will get an additional bill in addition to their insurance bill, which will come as a big surprise for a lot of Californians.
And do you think that would get it spread out for on a few years, right? It wouldn't be one chunk.
That's a great point. I mean, I think it's unlikely that all of that assessment would land just in month one. I think it's more likely it would be spread out over the year, over a course of years.
In terms of the insurance crisis that we have been facing in California, some people are getting significant price raises. Some people are losing their coverage. Where do you think everything is headed?
So I think in the short and midterm, the regulatory changes that the insurance industry asked for, they said would be sufficient to get them writing insurance again. Now, that was before the LA fires, but the LA fires really were not a question of if, it was really when, right? So the insurers knew last year when they asked for all these regulatory changes and said they would start writing insurance again, that there was a significant possibility and probability that there would be severe catastrophic wildfires somewhere in California. They've come early, but here we are. So I don't think that these fires should be a pretext or an excuse for the insurers to live up to their commitment to start writing insurance again. But they might start pulling back again. But let's assume they don't. And let's assume for the short term, the next couple of years, that insurers start writing insurance again. They stop being as aggressive in non-renewing. They start writing in the wildland-urban interface. In the long run, though, what's happening is the background risk of these extreme and severe weather-related events is going up. And the likelihood of losses is going up too. And so what's going to happen is that background risk and those increased losses is going to overwhelm whatever regulatory changes are being done in California or any other state for that matter to try to keep insurance being written. So I believe we are marching steadily towards an uninsurable future in this country.
There are some people, Dave, that argue that the reason we are having these fires is because of not managing the forests. What are your thoughts on that?
So it is true that in the United States, and particularly in the western United States, we have done a very bad job of managing natural lands, wildlands, forests, as well as brushlands like those around the city and in the city of Los Angeles. And with regard to forests, what's happened is we've had about 170 years of suppression of all fire in forests since Western settlement began. It used to be that the way that nature managed our western forests was fire was a routine part of the ecology. Fires would ignite, they would burn through the forest, they would remove all the low-lying vegetation and small trees, and our forests were characterized by older, more mature trees and a lot of open space. Well, then we had Western settlement, genocide against Native American peoples who used to do cultural burning, stopped that practice, and we stopped any fire in the forest, right? That was the dominant view of firefighters, both federal and state. Well, now our forests are choked with fuel as a result. So in the last 20 years or so, a practice has emerged with a lot of science behind it and a lot of empirical evidence that if we mimic the way that nature managed our forests and our brushlands by reintroducing fire to the forest, by thinning, not clear cutting, but thinning the forest to replicate how fire would eliminate vegetation, by removing and thinning the low-level vegetation, we can dramatically reduce the severity of wildfires. And that's true. And so the state of California has appropriated $3.6 billion over the last couple of years to do this very thing. In the bipartisan infrastructure bill at the federal level, there was about $5 billion for this sort of work across national lands. Cities and counties are taxing their residents to do this sort of land management, reduction of hazardous fuels. Homeowners associations and individual homeowners are doing defensible space around their homes, all of which is terrific and helps. However, we need to do both and. We need to address the underlying driver of the risk, which is climate change, and we need to do mitigation. Just doing mitigation is not going to solve our problem. It'll make things better, it'll reduce the risk, but it does not, by any stretch of the imagination, eliminate the risk, and the risk keeps growing because of climate change. But here's something else the insurers can and should do. So the insurers use computer models to decide whether to write or renew the insurance for your home and business. They assign your home or business a modeled risk score. The problem is that despite all of these different mitigation practices I've described, the models used by the insurance companies to decide whether to write or renew your insurance do not take into account mitigation. So you can spend thousands or tens of thousands of dollars hardening your home, defensible space. You're paying taxes at the federal, state, and local level for forest management or brushland management. And guess what? The insurance company still tells you we're not going to renew you. What we need to do is we need to require that the insurers' models account for this. So we need state legislatures and governors to stand up to the insurance industry and pass laws that say, look, we're spending billions on mitigation. The risk score models you use to decide whether to write or renew insurance need to account for that. So that's another major policy change we need to have to make sure insurance is more available in hard-pressed communities.
And it is actually, some insurance companies are becoming very tough. They're coming and actually looking at the homes and taking photos, and they're actually getting very thorough and analyzing how much vegetation you have.
They are. And I would say that to the extent that they're doing that and taking account of the good things you're doing, that's terrific. But if they're coming in and just saying, look, we don't like all these things you're not doing, and if you do, so we need you to do these things, and then you do them, and then they don't write you insurance, then what's the point? And that's the experience a lot of people have. They do all of the mitigation measures that the fire officials tell them to do, use impervious materials for the roof, shadow-resistant glass for the windows, protect the eaves of the homes from embers, not have any attached wooden structures, have defensible space 100 feet around the home, right? This is a partial list. They do all these things, they spend money on it, and their tax dollars are going to do forest treatment or brushland treatment, and then the insurance company still tells them, that's nice, but we're not going to renew you. So that's very frustrating, and rightly so for people.
Dave Jones, former insurance commissioner of California. It was great to have you on California Insider.
Thanks very much for the interview.